Good morning, I'm Bill Hubbard, Chief Economist at Trade.com, and welcome to our weekly market wrap here at Core Finance. And my guest this morning, Mark Oswald, Chief Strategist at ADM Investment Services. Well, Mark, before we get started, on this, the 30th anniversary of that slight problem with the global equity markets, where were you and what were you doing?
Well, at the time I was still working in Frankfurt, and I had a young lady starting who was going to work in our Zurich office, and it was her introduction or birth by fire to this is something which can happen in financial markets when they get too complacent. That last bit's probably the bit which has an echo nowadays.
It sure does. As I say, for you young viewers here, 30 years ago today was the slight problem we had with the global equity markets. As we saw last night, Dow closed at 23,100. It's up almost 14% for the last 3 months. And on that lovely day, it dropped more than 500 points, so 22%. But we won't talk about the bad times. Okay, Mark, now, everybody's talking about one and done, none and done, one on the 2nd of November, 2 or 3 maybe next year. Your thoughts, and remember we only have 15 minutes on the Bank of England, and not only the economic numbers that have sort of gone heading south very quickly, and the Brexit.
Yeah. Well, there you go. You've got your chart there. We are basically, I think we've moved the probability of a rate hike down a bit this week. We were about 82% at the beginning of the week. We're now down at 70. A lot of that is not really related to the economic data that we've had, either the CPI or the wages or the retail sales, which we can come to in a moment, but far more to do with our favourite unreliable boyfriend's testimony on Tuesday, Mr. Carney, in which he seemed to revert to equivocating. On the one hand, he said, I do expect to have to write a letter explaining an overshoot on the inflation target in October.
Again, for some of our viewers, okay, the target rate is 2%. If the target rate drops to 1 or below or 3 above, the chairman, or excuse me, the governor of the Bank of England has to write a letter to the Chancellor explaining why.
And to which one might think, oh, well, that obviously means he's going to be supporting one. But then he went on to say, I think inflation will, well, we think collectively, the MPC, it will peak then. And then he went on, and then of course there is this difficulty in our mandate, because as much as we have an inflation target, meeting the inflation target mustn't, at the other hand, be detrimental to growth and employment prospects. So we're left in this old situation where the Bank of England is not really sure what it should do. I think they probably have to go, because I think they've spent a lot of the last 4 years doing this bait and switch, I think one might call it, of teasing people that they will be needing to raise rates in the next couple of months, only to back off. This time around, they've been rather more forceful. There's been less may, and rather more, it's more than likely that we will have to. They haven't completely painted themselves into a corner, but they are left in a very awkward situation, because the market has taken them at their word, but the market's also saying, you're going to be one and done. I think the wisdom of it at the moment really is probably hugely questionable, particularly from the aspect of, what is the point of one and done?
Yes.
What's it actually going to achieve? Is it actually going to bring inflation down or help to bring it down? No. Will it support sterling? Because that's clearly a point of concern.
Well, as you just said, okay, when Theresa May had that very bad week, we saw sterling like 131.50, and it went back up to 135 when it looked like she was being supportive, okay? People really got caught. I guess Michel Barnier, early last Thursday, basically said, no chance of getting a done deal. We saw sterling sell off almost 100. Then in the afternoon, he said, well, maybe you misrepresented what I heard. And it went up 100. Now, this morning, okay, again, we've had another weaker number, okay?
Yeah.
This morning when I left home at 7:15, sterling was trading at 131.99. I last looked, it was trading at 131.51. A great retail sales number, or?
No, the retail sales number was poor. That said, it comes after a slightly downwardly revised number in August. So we had 0.9 in August, we had -0.8 this month. The ONS has told us basically that retail spending is going to contribute roughly 0.03 of a percentage point as compared with 0.09 of a percentage point to Q3 GDP, which you probably have to take in some context. Obviously, we know from this week's data that real wages are contracting at a pace of about 1%. So actually to have retail spending in positive territory for the quarter up 0.6% is probably quite a good result. It doesn't mean necessarily that GDP is particularly strong, but it's not a bad result given that we've got consumers being squeezed by by negative real incomes, a rise in inflation, and obviously fairly high levels of debt.
I think it was interesting looking at yesterday's employment numbers, okay? I mean, we're talking at a 42-year low, but the thing that I found quite interesting was the largest percentage of the 317,000 jobs in that 3-month period, more than 70% were females. And I know that the Federal Reserve has said, well, that could be one of the reasons why U.S. wages are not going up, because you've got maybe 2 earners now in a household rather than 1. So they're willing to take lesser paying jobs just to have that steady income. And we maybe start seeing that over here. So therefore, there may not be any real pressure on wages.
Certainly not. I mean, the income inequality, which is obviously self-evident in that, is an important factor to consider, but it's not necessarily one which is a concern for central banks. It is in the broader terms. In social terms, but the more important point is a lot of the jobs that are being created. So we can fake this this high level of employment that we have here in the UK, in the US, and a number of other countries. But what sort of jobs are being created, and what sort of pay levels, and why are so many women coming back to the workforce? Is it because they just want something to do and they would like to get out, or is it because the household's incomes are so pressured that both partners in a marriage, in a household, have to go to work,
yes,
which doesn't actually send a particularly strong signal about the economies.
No, and as you just said, in reference, okay, we got retail sales this morning in the UK, we got employment numbers. Well, now last night we got the Fed's beige book, okay, out of next week's meeting, okay? And for the first time, it seems like ages, all 12 districts said it was modest to moderate. And the reason why there was only a modest was the 3 Fed districts, Richmond, Atlanta, and Dallas, all hammered by the hurricanes. And one of the points that you just said, the key thing that they mentioned, there was a severe job shortage in construction, a la bricklayers, transportation. If you're a truck driver or HGV driver in the States with 3 years experience, you can start at a minimum of 50,000 sterling equivalent. And also the simple fact is there is manufacturing, okay? The robots still have not started. So we're talking about, you know, again, these aren't doctors, lawyers, and Indian chiefs, but these are the industries in the States and also the industries over here. There is a severe professional shortage. Over here it could be because maybe we're not getting enough immigrants.
Yeah, I mean, I think the simple point there is we've been looking at a lot of the job creation has been in really low-skilled jobs. Now that we're starting to see some upward pressure in terms of labour demand in sectors which pay better, like construction, like transport, perhaps that we've reached the point where we tip the scales on wage growth. There are structural problems with wage measures, but we haven't got the time to go into a long discussion of that. But it's probably the sort of thing which tips the scales on that front. And it also tells us probably that we're underestimating how much wages will go up. And in the longer run, we're also underestimating how much inflation is likely to go up. Now, the key point here is not that inflation goes back to some sort of 1970s disaster. The point is the market is assuming inflation will undershoot the ECB's, the Fed's, the Bank of England's, the Bank of Japan's target for a very long period.
Yes.
You know, for basically as long as the eye can see. So reasonably, one could say, well, the market can probably see about out 3 years, and then who knows what happens after that.
Let's just look at the next chart here. All right, as you just mentioned, okay, in 24 hours, we've gone from like 82% probability of a rate hike by the Bank of England, okay, down to 70. Yet overnight, we've gone from 74 to 82% that the Fed is a done deal for December. And then one of the things that we've seen, okay, whether it happens or not, in the market feeling, I think Auntie Janet is having a tete-a-tete with the president today. And the president is going to China for 11 days on the 3rd. So the market really feeling that by the end of next week, maximum, we will have a new Fed chair designate, okay? John Taylor or?
I mean, Taylor's been much discussed because, according to sources, Mr. Trump liked him. Taylor is also seen as being hawkish because he is the father of the Taylor rule, and under the Taylor rule, you probably, if you take the raw mechanics of it, and it is very mathematical, we probably need to have rates at about 3.25%, which is seen as dollar bullish, and obviously very bad for interest rates. I still don't think he's going to get the job. I think Mr. Trump's main ambition with the Fed chairman is to have, and I think this is also why Mr. Fisher left the Fed early, is to have someone there who doesn't object to the rollback of post-GFC and above all Volcker rule regulations for the banking sector, which both he and Mr. Mnuchin, his Treasury Secretary, desperately want. They don't need noise off stage coming from the Fed saying, we don't think this is a good idea. So Mr. Powell is probably the favourite on that basis, simply because he has said, yeah, he can see the case for some rollback.
Yes, and I think the key thing is, if we believed Trump's inauguration speech, $1 trillion infrastructure program, as you mentioned, deregulation and tax cuts. Well, this isn't conducive to having, as you say, rates at 2.5%, 3 or 4%. So it's a situation where we need that balance. But if you were a dollar bull, you sure did like the mention of John Taylor's name in the last few days.
Oh, absolutely. And I think there are a lot of frustrated dollar bulls out there. There's no doubt about it. I think in terms of sterling, going back to that, there are a lot of people looking at that and saying, well, yeah, if we are one and done.
Well, let's very briefly look at the next chart. But I think this is the key, and we talked about this earlier in the week. You mentioned it, and I looked at some of the Bloomberg charts and saying, wait a minute, is there trouble ahead? I mean, the numbers that people are talking about, maybe rate hike here in November, maybe 1, possibly 2 next year. Well, all of a sudden, if you're just looking at the charts don't seem to indicate this.
No, I think what this chart, which is the spread between LIBOR, which is unsecured lending, and the overnight index swap, which is secured lending, that's an important distinction, particularly in the post-GFC environment. It basically tells us that we've got a slight premium for secured lending. Now, that probably is down to the fact that because the Bank of England has been shilly-shallying around on the rate hike front, because we've got so much Brexit-related uncertainty, which will have an impact on the rate outlook here in the longer run, because there are completely different outcomes, potentially, depending on what is or is not agreed, or whether the UK actually really does walk away from the table. So suddenly you've got to this point where there are people trying to secure current rates, not knowing where they might be, and obviously on the other side of the equation, the banking sector saying, well, not without collateral. I'm not lending anything unsecured at the moment because I really have no clue myself.
Well, I mean, in reference to that, I mean, I think one of the things that even the Bank of England has specifically mentioned is the slight problem with automobile financing.
Yes.
I mean, a real problem, a real concern.
Well, there's a problem with automobile financing because it's absolutely ballooned. When you look at some of the statistics relatively, one of my colleagues who's a bit of a petrol head was showing me just how much, if you look at the traditional auto loan financing and then you look at the lease financing, basically now the volume, they used to be roughly matching, and now lease financing is about 5 times standard. So there's clearly a bubble there, which, because of the mechanics of leasing, could create a problem. And there's clearly a problem in the commercial and, to a certain extent, particularly in London, the residential property sectors. And those are all things which bear down on financial stability and could pose troubles ahead.
Now, I guess the last question. friend of mine, or a gentleman I know, okay, who was the first person I knew ages ago, was talking about the hike on the 2nd of November. I know he is vacillating, and this is before this morning's number about whether they really needed to do one. So, I mean, the simple fact is, where would the Bank of England be in reference to street cred if they pass on the 2nd of November, especially if all of a sudden Theresa May has a very ugly dinner tonight, and the boys from the EU say, sort of, up yours, Dolores.
I think if the bank doesn't go at the beginning of November, I still don't think it's the right thing to do. But I think if they don't go, what is left of their credibility, which has been severely shredded because of their forecasting record, because of their ability to misread the economy on so many occasions over the past 4 years, would be completely shot. And in that sense, obviously, that's very concerning, because we've got a government which is at war with itself. And if we then say that the country's central bank has no credibility whatsoever, then the UK is really facing a bit of a nightmare.
Well, I guess let's end it here. I'm with you. I don't think they should, but I think the Bank of England will move on the 2nd. I think the safe move, whether Janet Yellen has a job on the 1st of February next year, the Federal Reserve, and we'll just sort of let the ECB wander. So, Mark, thank you very much for joining us today, and good luck.
Pleasure.